October. All right, it's time to bring in our next guest. That's going to be Phil Strebel, Chief Market Strategist at Blue Line Futures. Welcome back to the show, Phil.
Yeah, thanks for having me on, Tom.
All right, so let's talk equity markets a little bit. A little bit of a break yesterday, but you know, S&P 500 is still up about 20%, but it feels heavy here, Phil. What's your thought process here? Do we need this type of consolidation or a slight pullback? Are you still bullish here on equities?
Yeah, I'm still bullish on the equity markets. I mean, I think you define your edges on the week here, and you look at 58.30 being the upside, 57.25 on the downside. We've tested that lower level a few times. Markets have bounced back from there. That's actually the September S&P 500's contract highs. So that old resistance is now new support. But historically, you look at where we're at now and what happens into the end of the year. You got to break this thing up into three different segments. You look at from here to the Fed meeting, from here to the election, and from here to the end of the year. And my focus really is on that tail end of the year, because regardless of who wins the election, historically, since about 1900, regardless of political party, we've seen the November rally and the December rally in the S&P averaging about 3.4%. And historically, you go from about Halloween until Christmas, the S&P 500 has been up 15 out of 15 years.
Now, if you take a look at what we saw last year, in the S&P 500, we were really weak going into, the last few couple months of the year, going into the holiday season, which is historically really good. But with the market up nearly 20% already this year, we haven't seen a sizable pullback at all. Does that kind of warrant maybe a little more caution? Because the VIX is still at 22, Phil, right now. So it's kind of giving you that burden of uncertainty, right?
So this is where we focus on really risk management. And a lot of the clients that are working with myself, what we've done is we've established end of October put spreads in the S&P. So it's the 5700, 5625 put spread. So we put that in place, and we call that bit like our life jacket here, or our parachute, if the market does sell off. And what we've been doing is we've been adding some of the equity indices as the market comes down to correct in that level, because we do believe that we're much in a trading range. Now, the volatility is definitely going to pick up with the Fed minutes, CPI, PPI as the week progresses. But we are in the camp that any kind of serious correction on the equities should be met with investors redeploying capital in the markets, and prices should push higher.
Yeah, and I think that's, part of the reason that we haven't had any sizable pullbacks is I think so many people are sitting there on the sidelines waiting for any kind of dip to get back into the equity market, because, I understand that the Fed is data driven at this point, but the data that we've gotten, Phil, lately kind of calls for the fact that, hey, it might still be risk on, right?
Yeah, with the increase in the labor market on those numbers, it shows you that the economy may be still quite robust. So I was a skeptic of that number coming in. I thought that the number would have come in much lower, but the fact that it blew away just kind of reaffirms where we're at. Now, who knows a year from now if we'll see, what we saw earlier, where they have to adjust and revise those numbers down significantly. But, who knows? Coming into this election, I think that we're going to continue to see robust economic data further supporting the current administration at the moment.
Yeah, and if you take a look at, the action in yields right now since that 50 basis point cut, we've done a complete 180 here, where you've got the 10-year now at 4.03%. First time in a couple months that we've seen that level. Do you see that, being part of the lift that equities are getting right now? Because, hey, that just means the economy is doing well if yields are going up. But then that expectation that the market had that, hey, lower yields, we're going to continue to see that. It's kind of reversed that narrative, right, Phil?
Yeah, the yields is really a tricky situation. I mean, it should play some kind of short-term headwind. But if you look at one of the most yield-sensitive commodities, like the gold market, which focuses on real yields and a 2-year yield, gold futures are pushing back up. They're in a $50 trading range right now. They've been quite supportive. And something I did was I looked at, hey, when we had that shock to the upside on the 2-year yield, what I looked back at is What you'll do is pull up a daily chart, look at the 2-year yield, then look at the last time we were at this elevated level, and then you go to a commodity like the gold market, and gold futures were about $150 lower, trading at 25.30, and we haven't seen that kind of breakdown. So the correlation's not necessarily there, or markets are shrugging this off as a one-off event. I was a little bit taken back that all of a sudden the 50 basis point interest rate cut was completely taken off the table. There's about a 13% chance, according to CME's Fed Watch tool, that the Fed leaves rates unchanged here. So it's really interesting how week to week things are changing in a quite sizable matter as far as the economy and projections of what the Fed does.
Yeah, because it seemed like, the yields falling, kind of begging for the Fed to cut 50 basis points. Then it comes and then they completely reverse. But then everybody kind of pivots that narrative to, hey, well, that just means the economy's doing well. And hey, yields can go up when equity markets go up. But you mentioned gold, and that's been in a landing zone here due to the fact that the dollar's been rising. Are you surprised by this move in the greenback at this point, Phil? Because it's probably not allowing gold to get back to those all-time highs that we saw a couple weeks ago.
So that rally in the dollar, if you look at the chart, it posted a double bottom, bounced off key levels of support. We were expecting a short covering rally. Where our focus is shift in the currency space is really on the British pound, which has been sold off aggressively. If you look at core CPI out of the UK, that's reached a 4-month high and is in an uptick. This comes after last week, one of the Bank of England governors came out and said they were going to aggressively cut rates. Well, their core CPI went up. You look at their housing data, it shows that housing prices are appreciating. It was up 4.7%. Inflation's back on in the UK, and I really believe that interest rate cuts in the UK are off the table. That's why I think from a currency standpoint, the British pound is going to be your best opportunity back to the upside.
Yeah, and, I don't know if it's part of a safety play when people are pushing into the dollar. That might have something to do with it, just due to the fact that, equities were at all-time highs recently. So hey, it's not a bad idea to kind of diversify, especially if you mentioned bounced off of those lows. But you look at the crude oil market here, Phil, and there's some volatility for you at this point. But that might be the overhang on the equity market. Also is the fact that there's those geopolitical risks out there causing a lot of volatility in crude and the energy markets, right?
The rise in the crude oil prices and many other commodities because of the conflict in the Middle East supports our thesis that this next CPI report will most likely mark the low and inflation will start to head up from here. The thing that I think about when I look at crude oil is part of this recent rally has been speculation that Israel would target Iran's oil production facilities. However, I think that would be a great escalation in the conflict that's going on. So I don't believe that that is on the table. Also, it would disrupt just the global economy from a shock to the upside in oil prices. There's speculation that if that does occur, we could see $10 and $20 spikes in Brent crude oil. So, and what would that do to the economy? Really cripple it here, and it would really spark that inflation. So I think oil prices are a bit overvalued at this point. I would look for some kind of correction down into the low 70s before establishing new longs.
Yeah, we had a conversation with Carly Gardner yesterday. She's still eyeing that $65 a barrel level, even though people are calling for $80 a barrel. But I think the U.S. did kind of stymie maybe Israel's attempt to maybe target the oil, ports from Iran. So maybe that's off the table at this point, seeing some weakness here, down 2%, back near 75.5 a barrel, which is good. But to tie it all up here, Phil, looking forward, you're still saying buy any dip at this point. But like you said, we've got the Fed minutes coming out. We've got CPI, PPI coming out. So it could be, this relationship that you have to watch the data also, right?
Yeah, this is where volatility takes place at the end of the week. So this is where position sizing becomes paramount and also risk management. So investors that are highly leveraged in many of these commodities could look at shorter dated option strategies to try and help hedge their position. So you don't want to be a hero in any particular type of market. You want to define your edges, stick to your plan, and trade your plan.
Oh, boy, you're speaking my language there, Phil. More options trading needed. I love it. Great discussion here, Phil. Have a great day.
You too.
All right, that's Phil Strebel, Chief Market Strategist at Blue Line Futures. But coming up after the break, Andrew Wang, he's going to join us to cover PepsiCo earnings and the equity market.